Welcome back, traders. My name is Manuel Fonseca, founder of Smart Habits. In today's video, I'm going to explain to you what is liquidity, where are the liquidity traps, and also how some patterns we have learned do not work when we don't know or we don't spot the clear market direction. If you want to know more about my strategy, I kindly suggest you to download my free ebook, which is in the link of the description. No more to say, my friends. This is everything, and let's see the video you came here to watch. Excellent, guys. Let's start with the definition of basic liquidity. So liquidity in trading is basically where the money is seated. Think about the next, okay? Or every time you place a stop loss, every time you place a pending order, that's money on the table. And institutions know this. Liquidity zones are areas where lots of traders have their orders stacked above highs, below lows, or around obvious support and resistance level. Okay, so with this in mind, all the market is money. Practically, it simply moves from one point to another because there is more money in one part. It could be up or down. Okay, let's say it in those terms. So what happens here? Liquidity appears especially in the highs or in the lows. In the previous video, I explained to you how to identify strong highs and strong lows, which are zones that are very important to identify where the money is located. So let's imagine the next. Big institutions put their orders here. Let's say a really huge bank buys in this zone where I have the mouse here, and it means that all the price will keep pushing up because they just put a really big order. Now, what happened after certain movement? Another institution or any other bank set another limit order here or just sell money here, and they keep pushing selling, and that's why in the market there are certain retracements, correct? But let's say this position was bigger than this one that was here, right? And the price just keeps simply moving towards the direction of the first institution. Okay, in other words, this is how the price moves. Okay, now we need to understand that in this type of situations, we as retail traders need to understand what is the real market direction. And with that in mind, it means that we will be able to execute, let's say, the most accurate orders possible that we can. So imagine the next. In the market, we will see the next, all the candles, and all the candles represent money. You already know that, right? Then the price keep pushing up, right? Now, here is where we are mostly trapped because we start seeing here that the candles make certain patterns that we have learned through different information online, and we start like putting our orders right here. So what happens? It means that millions of retail traders start putting lots of money here, lots of money, and then it becomes like a really profitable area for the institutional traders to, let's say, yes, trick us and make us think that the direction of the market is different. So the price may go up here. Most of the people with this candle would consider that is a proper order or is a nice order to keep executing. And after that, the price just keep moving towards the real direction, which was in this example, a bullish trend, correct? So this is what mostly happens with the liquidity, right? Now, we as traders, we need to understand that in every high, in every low, or in every obvious, as it says, the magic word here is obvious high, lots of traders put orders. Then we have the price has certain reaction, and if we don't know properly the area, we may lose that. So as an example here, we could see that the price goes down to give us certain insight of selling, but then it keeps pushing up, right? The question here is, how many of you have encountered this type of situation, which you put an order that you thought it will be positive, but then the price keep pushing up and then you lose that order? I think many of us have suffered that. And that's why most of these areas that are just like simple resistance zones, after a period of matter of hours, becomes a really huge liquidity pools, right? Where the institutional traders takes our money. Right, now with this definition of liquidity, and we already know that with the highs and the lows is where most of the liquidity is accumulated, we just need to understand something that is called liquidity traps, of course, in order to avoid. Now, liquidity traps, let's see the definition. A liquidity trap occurs when the market creates a false breakout or lure traders into a wrong direction by targeting their stop losses or pending orders. Okay, this actually happens in all the time frames, but especially in lower time frames, aka 5 minutes, 15 minutes, or below of that range. Okay, now institutions will purposely push price above the strong high or below the strong low, where retail traders usually place stop losses, and once the orders are triggered, price quickly reverses in the opposite direction. Okay, so if you haven't seen my video of strong highs and strong lows, I kindly suggest you to watch it to recognize the real direction of the market. So as an example here, let's imagine that this is a strong low, which means that it is mainly an uptrend, right? And those who already know, this will become a weak high. It's called weak, of course, because there's more possibilities that this high will be broken, right? Now, if you already know that the price is in a bullish trend, most of those liquidity traps will occur when the price make a weak high. What do I mean by that? It means that when the price hits this area here in the high and start making like certain lows, here is when we start seeing certain patterns that make us get confused. And then we thought the price will keep following a certain direction, in this case, like a bearish direction or a downtrend direction. But in fact, it just reaches certain zone, for example, here, where is another liquidity or simply an order block or a good point of interest, and then the price keep pushing up. Okay, so as it says, and we explained in the previous example, most of us start putting orders here to considering this will work, and then there is when we start like losing our trades. Okay, now let's see this in a clearer example here in the market. Look, let's put as an example this. So in this high, we can recognize here this is a strong high, and this will be a weak low. Now this will be the weak low. Perfect. So apparently, after seeing this huge impulse, we would say, of course, this is a downtrend. Yes, practically yes. But now look at the next. The price reacted here for any reason. We're just gonna assume that here is a liquidity pool or an order block or a high time frame zone, which the price simply has a reaction, keep pushing up, right? And now let's try to analyze the nearest highs, like this one. This is the nearest high that we have here. So most of the traders, when we are in this type of situations, we see this huge candle. Now, institutions activate those orders that are called buy stops. So they just activate those people who thinks that after breaking this resistance zone with a candle of a body, it will keep pushing up like this, right? So people start buying. People start buying at this point. But what happened after that? We see this candle, red candle, which means selling orders. And what is the first thing you can see here? Here is a high and here is another high. So you see a pattern called double top, correct? That's right. So you just put another order here, right? Now you are already confused because you don't know the real direction of the market, right? What happened after that? We already know that when there is liquidity here, people accumulate lots of money. So it means that after hour or minutes passed, there is lots of money on those highs. This is a 1 hour time frame. So if we see this in lower time frames, like 5 minutes, we start seeing patterns like double tops or head and shoulder patterns. And what do? The same things I did in the past. You just put more orders. You execute more orders because you want to win, because you think this is the correct direction of the market, right? And after some hours passed, the real movement shows up. Here, with this candle, you start feeling anxiety. Maybe you lose some orders. Some of us have put some trades with more size than we should have done. And with the pass of the time, we see this we keep executing more orders. Some of them grab what they can have, right? Like certain few dollars, few money, and some of those who wants to bear a little bit more, wait for the price to do the real movement, and here is when we start like losing our money. With this movement downwards, the institutional traders just took all the money or the stop losses for those who were buying. Remember that there were people buying at this high. So this is how liquidity works. And this is one of those liquidity traps that we should start, or we need to understand avoiding. Now you would say, why, Manuel, after this very clear 1 hour range, yes, the price keep pushing up? Probably, and we just have to see in, I don't know, 4 hour or daily time frame, this was just a simple retracement, and this is a impulse in 4 hours daily or even weekly. Okay guys, I just want to remind you something. I just have made an ebook, okay, which is called the Simplify Smart Money Blueprint. This is one, it's my simplify strategy, which I explain in different phases. In the first two videos of this channel, I explain the phase one, which is the market structure awareness, and where I explain how to identify, how to spot a strong high or a strong low, and the real direction of the market. Today's video is about the phase two, which is called liquidity understanding. So I will keep posting videos explaining this strategy. My piece of advice is just watch these videos, do some of the homeworks I'm gonna let here for you, and do it on your own, make your own conclusions, and use this because this strategy simply works. Okay, now let's continue with explanation. You are here watching. Perfect. Now let's see in this moment key points of liquidity trap. We already know this, okay? So they are fake moves designed to grab liquidity. They target obvious stop loss areas above highs and below lows. After the trap, the price usually continues with the real institutional direction, okay? Let's make a draw to make this even clearer. So imagine the next, we're in a bullish trend. Let's imagine that we are in a bullish trend. So pushing up, right? Pushing up. Where do the liquidity traps occur? Here, for example, in these zones, what are the support areas or resistant areas, right? Here is more liquidity traps, and here you will see more liquidity traps. I mean, it doesn't mean that you cannot take advantage of those small retracements. You can actually do it, but when you are more advanced and have more understanding of the market structure and direction, okay? So we're just gonna make an example of, imagine that we are located right here. Imagine that we are in this zone or even in this zone, okay? And we're just watching this, that you already know this. These are patterns or reversal patterns that we may found on YouTube, Google, TikTok, or Instagram, right? And I'm gonna show you why they don't work if you don't understand the real direction. So assuming that we are in a bullish trend, okay, going up, remember that we are just, imagine an example that we are just located here, where it is like there are the support areas. So you go and you see the next. This is a bullish trend, right? We already assumed this, correct? And we see this beautiful pattern, which is called a channel or a rising wedge, which is a pattern in which people would consider make three tops here, three touches here, and also three touches here, kind of, right? And what is the pattern says? What do the people say it will do? It will change the direction of the market, right? It will change the direction of the market and will keep pushing down, right? Now, remember, we are just located here. So it means that the institutional direction is bullish. And in these zones, where are highs or support areas, is where the institutions create fake patterns for us to follow. And what happens after this? You see the pattern, you just put your order, because according to the pattern, it's like this. I don't use this pattern, guys, so if I'm mistaken, guys, I'm so sorry. But you just put an order just like this, kind of, and you would say this will keep continue down. Then the price do the next. All right, sorry, if I'm not mistaken, the pattern works like this. Breaks the structure of this low, yes. Then you put the order here, and then what happens? It activates our order, boom. Give us a little bit of joy, not enough to continue or grab enough money, but probably if we are greedy enough, we put another extra order, and then what happens? Boom, I don't know, probably it was a piece of news in the market, or It's a simple movement of the market, and you are. And because you feel kind of anxiety, then you start seeing different patterns. Like here, you see, oh, no, no, no. This channel or rising wedge did not work, but I'm seeing here a double top pattern. So I put another order here. Boom, you're out. Now, okay, it did not work. Maybe this because it's higher, it's in time frame. So probably it will be here. Boom, you're out as well. Now you are out of 3 orders, which is psychologically painful for you as a trader. So this is how I show you how this channel or rising wedge do not work because you're not following the real institutional direction. All right, you want to see another example? Let's see. We're assuming again that we are in a bullish range, okay? Bullish range. And in these ranges is where this occurs, okay? Now, let's see how the double and triple top pattern do not work when you don't follow the real market direction. Again, how is it? Is in this way. Again, bullish trend, right? The price starts making a consolidation. In the consolidation phase is where we start like looking or seeing this type of patterns. Very obvious. We just see a triple bottom or a double bottom pattern. Of course, we put our order as it says. When the price touches or makes the M pattern or whatever you call it, right? You just put the order, wait for a minute. Of course, the price provides you certain type of joy because it's just activating other people's orders. And this is what the price do. Goes a little bit down, probably takes the liquidity of this low. I just draw here and keep pushing up, right? Have you lived that type of situation? Maybe, right? I have lived that. And I'm teaching you this just for you not to suffer that again, right? All right, let's see the next patterns. And with that, we're gonna finish this explanation. Is the moment for explaining the flat wedge. The flat or the wedge, which is another pattern, is common in the market, right? So according to this pattern, if I'm not mistaken, when the price makes it's a downtrend. I'm not so sure. Sorry, guys. The price makes something like this. Breaks the channel, if I'm not mistaken. Breaks the channel a little bit down, pushes a little bit down. Here is where you put the order, right? Here is where you put the order, and you assume it will keep pushing down, right? Because it's a reversal pattern. Now, what actually happens is that, remember that we're in a bullish trend. We already know that, right? Perfect. And here the price activates of order, and the same story happens again. I know you have lived this because I have lived this as well. That's it. Just a huge candle or a piece of news, something like this, take us out, and we're done. We're done for the day, for the week, or this is even more painful. The price pushes up. Here is making more patterns that confirms that it will going down, and slowly the price takes your money, right? It's even actually for me it's actually worse. The worst way how the price works, because it takes our money little by little, because we just keep pushing and putting extra and extra orders, and then boom, I don't know, in New York session or in London session, probably when you're sleeping, you wake up and you see, gosh, I have lost another 3, 4, 5 orders, right? Finally, we just have to put in, as an example, the head and shoulders pattern, which is right here. I'm gonna put myself here. So head and shoulders pattern, same story. You already know how it works because you have already lived this. Bullish trend, perfect. It gets to a consolidation stage. The head and shoulders pattern works this way. So we have shoulder number 1, we see the head, then we're gonna wait for the price to make another shoulder and break or resistance level. And when it breaks the resistance level, we just put our order here, right? And then we're just gonna put the stop loss slightly up the closest high. This is how it works, correct? And yes, it provides us a little bit of joy, as I said. So the price just make a small movement towards the direction we expect it will move, like this, slowly and painful. And then it gets to a certain zone, and boom, 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 and boom, we're out again. Why is the reason all of this happened? Because we don't know the real micro direction. In today's video, we have learned how the liquidity works, where the liquidity is located, and what are the liquidity or most common liquidity traps that we used to fall in. Okay, so this is it for today's video, guys. I hope this clarify some of your concerns about how the real market moves. And if you really like this video, I just want you to share it with a friend, subscribe to the channel, and stay tuned because there's more explanation to come. Okay, thank you so much, and I'll see you then, my friends, in the next video. Bye bye.